This lecture is about corporate finance, which is an important part of finance because it deals with all the financial decisions within a private business, within a company. The various scholars make relations between the corporate finance and financial management. Some others say that there are distinguished differences between the two fields. For our case today, we will assume that they are equal, so corporate finance and financial management for our purposes will be the same. So what is corporate finance? Corporate finance is the area of finance dealing with sources of funding and the capital structure of a company and the actions the managers of the company take to increase the value of the firms to the shareholders. It also includes tools and forms of analysis to allocate financial resources to the company. There are two approaches when defining the function of the corporate finance. The traditional approach says that the corporate finance is the management of the financial resources of the business. So basically, it only deals with the sources of financing. The modern approach says that corporate finance includes also the investment decisions and the day-to-day current financial operations of the company. And in our lecture, we will assume the latter. So basically, corporate finance has three main areas of concern and one that is connected with all of them. The one connected to all of them is planning in finance. It is the process of making important decisions before the beginning of the financial cycle. And we will elaborate on the financial cycle in a few moments. The three main reasons, basically the three main questions that the corporate finance should answer is sources of funding of the company. So how do we find and what sort of funds should we collect? Second question is, now that we have the necessary capital collected, what sort of investments do we do with this? What sort of assets do we buy, for example? What sort of intangible assets do we invest in? What sort of liquid finance funding do we keep? And so on and so forth. And the third main area of concern of corporate finance is the current financial management of the day-to-day operations. The functions of corporate finance are aligned in the so-called financial process. They have it is a cycle of activities that occur regularly, typically within the same financial period, which is in most cases 1 year. So the first phase of the financial cycle is planning and budgeting. It includes all the preliminary decisions that have to be taken before the start of the financial operations. It includes setting budgets. It includes deciding on sources of financing. It includes deciding on current tactics of dealing with finance. Second phase is the so-called resource allocation. It has two aspects. It is resource allocation to set of assets or given asset, or basically in what do we invest. And the other aspect is resource allocation from what sort of sources, what source of capital, and so on and so forth. Third phase is operating, monitoring, safeguarding, and all the other necessary activities that we should do for the current financial management. These includes all day-to-day operations during the financial. And the fourth and final phase before the end of the cycle is the evaluating and reporting of the progress and the activities that have been done financially for the financial cycle. When this reporting is done, we are ready to begin a new cycle, starting with planning and budgeting and so on and so forth. Now, before we continue with the details on the corporate finance and financial management, we need to get acquainted with at least two other important ideas. First, it would be the various forms of organization of business, and second, we need to get acquainted with the various financial statement analysis. And then we can go on with the corporate finance. Now, let's speak about the various forms of business organization. There are many different types of regulations across the world, and there are subsequently many different types of forms of organization in business in different countries, in the different countries. But there are always four general types that are common in all places all over the world. The first out of these four is the sole proprietor. The second is the general partnership. The third is the limited liability partnership. And the fourth is the corporation. Each of them have pros and cons, which we will analyze further down the lecture. Starting with the sole proprietor. This is a company owned by a single person who typically is the loan manager as well. And the owner maintains title to the assets and the profits of the company. There is unlimited liability, which means that the owner is liable for all the losses of the company with his or her own property. And the termination of the company could occur at two different types of occasions. First, it will be terminated if in the case of death of the owner. Second, it could be terminated by the choice of the owner whenever he or she decides to close down the company. Typically, the sole proprietor is suitable for a small business where the loan manager and entrepreneur and owner is doing a small size business. General partnerships. In general partnership, just like the sole proprietor, we have unlimited liability for the company owners, but here there are more than one company owners. They are partners. Each of them has his or her own share of the company based on their initial contracts. The limited liability partnership. It is somewhat similar to the general partnership in the sense that there are several partners, several owners to the company, but there is a huge difference, which is to say the owners are only limited liable, restricted to the amount of capital invested in the partnership. Corporations. A corporation legally functions separate and apart from its owners. A corporation can sue, be sued, purchase, sell, and own property. Owners, in this case, are called shareholders, dictate the direction of policies of the corporation, and oftentimes this is done through elected board of directors, which is to say that in corporation we have different people conducting the managerial duties from the owners. So we may speak about professional managers in this case. A shareholder's liability is restricted only to the amount he or she has invested in the company. The life of the corporation does not depend on the life of the owners. Corporation continues to exist through easy transfer of ownership. There is, however, one big downside, and it is a double taxation. Every income in the corporation is taxed first as a company taxation, and after that it is taxed as a owner taxation in the case there is a paid part of the profit to the owners. What are the main benefits of the corporations as a form of organization of business? First of all, there is limited liability to the owners. Second, it is easy to transfer ownership. Third, there are conditions for professional managers. Fourth, through corporations, it is possible to collect a large amount of capital. And five, a corporation may have unlimited life. The drawbacks of a corporation are in the heavy regulation that the corporation is under. There might be huge delays in decision making because some of the decisions have to be made by the General Assembly of the shareholders, and it might take some time. And of course, we already mentioned the double taxation. The conclusions about the various organizations and forms of business: the sole proprietor and the general partnerships have the drawback of having unlimited liability. On the other hand, the sole proprietor is very flexible and very adaptable to the market, whereas in partnerships there is possibility to have division of labor among the owners and among the managers, which means some sort of specialization. So, for example, one of the partners could be doing the financial management, another would be the business operations management, third might be human resource manager, and so on and so forth. The limited liability partnership is somewhat better to the general partnership. The difference here is the main difference here is that some of the partners of limited liability partnership may not be liable for the full extent of the loss of the company, but only to the extent of the invested sum they have in the company. And then the corporations have other strengths, mainly the professional management and the ease of transfer of ownership and the ability to raise huge capital. Next up, we're going to speak about the financial statements. Of course, accounting is the science that deals with all the financial statements in the company, and of course there are many different types of financial statements. In our lecture today, we're going to have a look at the three main financial statements. Namely, this would be the income statement, the balance sheet, and the cash flow statement. The income statement. It is also known as the profit and loss statement. It measures the result of a firm's operation over a specific period, typically 1 year. The bottom line of the income statement shows the firm's profit or loss for the period. Basically, all the incomes for this period are represented on one side of the statement. All the expenditures are represented on the other. And if the difference is a positive number, then there is a profit. If the difference is a negative number, then there is a loss. Typically, when we start to analyze the profit and losses statement, we start from the revenue or the sales. We deduct the cost of the production of the service or goods. And when we do this, we conclude with the gross profit. Then we deduct the operating expenses, which basically means all the non-production costs, marketing, administrative costs, transport costs, and so on and so forth. And we reach the so-called operating income. Then we have to deduct all the interests and all the financial expenses of the company. And we reach the earnings before taxes. Then we deduct the taxes and then we reach the so-called net income or financial result of the company. And if it is a positive number, then we have the balance sheet, unlike the profit and loss statement, is not a measurement of a period of activity, but only a snapshot at the given point of time. So, for example, a balance sheet at the point of time of 31st of December only represents the company at this point of time, not for the whole period before that. The balance sheet provides a snapshot of the company's financial position at this particular date. It includes three main items: assets, liabilities, and equity. Assets are resources owned by the company. Liabilities and owner's equity indicate how those resources are financed. And basically there is a simple equation: assets equal liabilities plus equity. The transactions in balance sheets are recorded historically and at cost price, so the book value of the company may be very different from the current market value. So there are two sides of the company balance sheet. Typically the right side is called equity and liability. The left side of the balance sheet represents the assets of the company. The right side represents the equity and liability. Let's start with the assets. There are several types of assets. We start with the current assets. They comprise assets that are relatively liquid or expected to be converted into cash or other assets within 12 months. Current assets typically include cash, accounts receivable, which are basically the expected payments from customers, inventory, which are raw materials, work in progress, finished goods, or unsold goods, and other assets, prepaid expenses, and so on and so forth, which are liquid that could be sold within, which are liquid that could be turned into cash within 12 months. Fixed assets, they include assets that will be used for more than 1 year, so for more than one financial cycle. Fixed assets typically include machinery and equipment, buildings, land, and so on. Other assets are neither current assets or fixed assets. Intangible assets are such assets that do not have material form. For example, patents, copyrights, goodwill, or know-how. The right side of the balance sheet includes all the liabilities of the company and the owner's equities. We'll start with the liabilities. First and most important part of liabilities is the so-called debt. This is the money that have been borrowed from a creditor or must be repaid at some predetermined date. Debt could be current, must be repaid within 12 months, or long-term, which means that the repayment time could be for a longer period. The current debt typically includes account payable, which is credit extended by suppliers to a company when it purchases inventories. Short-term notes, borrowing from a bank or lending institution due and payable within 12 months. The long-term debt consists of borrowings from banks and other sources for more than 12 months. Next up is equity. It is the shareholders' investment in the company in the form of preferred stock or common stock. Preferred stockholders enjoy preferences with regard to payment of dividend and seniority at settlement of bankruptcy claims. Okay? And finally, retained earnings. This is the cumulative total of the profits so far in the company that, instead of being distributed among the shareholders in form of dividends, have been retained by the company and reinvestment back into the business cycle. So, in a general view, the left side of the balance sheet includes all the necessary assets to have a running company, and the right side includes of the equity, and the difference between the two is the sum of the liabilities, which means that the liabilities are there to fill the gap between the raised equity and the necessary assets for the company. If we look from the financial manager's perspective, the right side of the balance sheet deals with the question of how to fund the company. The left side of the balance sheet deals with the question what investment should we do. And the current operations of the financial managers are typically seen in the cash flow statement, which we are going to speak about next. The cash flow statement is simply a backlog of all the incomes and all the outgoing expenditures for the past financial cycle. It gives an idea of what was the difference for each of sub-periods, for example, as for each month, between the incomes and expenditures, and it is indicative of what the current financial operations were. So why do businesses need finance? Well, there are at least three possible reasons for that. First is when the business starts up. At this moment, the company probably needs buildings, machinery, raw materials, office equipment. So basically, typically long-term investments. Second, it might need working capital. These are all the short-term finance required for the day-to-day running of the business. Typically, this is short-term financing. And of course, there is always the possibility of unforeseen events, sudden decline in sales, large customer fails or to pay on time or pay expenses quickly. So for these cases, the companies have typically standing contracts with banks, or they just have a financial reserve at their disposal at all time. There are two main types of sources of finance: internal source of finance and external source of finance. The internal sources of finance are those for which the finance is raised internally. It does not increase the depths of the business. For example, this might be retained profit or personal savings of the owner of the company, especially if it's a small company, or sale of unwanted assets. External sources of finance are provided by people or institutions outside of the business. It creates debt that will require payment. For example, bank loans or overdrafts or new shareholders and so on. On the other side, there is another aspect that have to be considered, and it is the time periods for finance. Generally, without being a strict rule, there are three types of time periods in finance. First is the short term, which is typically considered within 3 years. Medium term is 3 to 10 years, and long term is above 10 years. So what are the typical short-term finance needs? These are needs for the day-to-day running of the business, and it's usually for a period of up to 3 years, as we already said. Typically, this means cash flow management. This is looking for short-term holes in financing and covering them with short-term sources of financing. Medium-term finance is normally throughout 3 to 10 years. Typically, purpose for obtaining medium-term finance are such as to replace expensive equipment, to expand, and to meet other coming opportunities in the business environment. The long term is usually thought as being above 10 years. this finance is for securing the resources for long-term growth, and it is the strategic decisions of the financial manager. Sources of long-term finance could be long-term loans. This is an external source. It could be issue of shares. It could be issue of corporate bonds, which is again external source of finance. Before we go on with the company stock and corporate bonds, let's consider the bank loan. What are the factors influencing bank decisions to lend? First of all, it would be the past track record of the company. If it has been a moderately successful company, it would get the thumbs up from the bankers. Then it would be the purpose of financing. Then it would be the type of products that the company is selling. It could be the current financial position, it could be business proposal, it could be financial projections, it could be the nature of the market and sales forecast of the company. And all those are outside of the hand of the financial managers, and they are considered by the bankers. Moderately complex decision. And banks use all this information to determine who qualifies for lending and who doesn't, and to determine what interest rate will they lend at, what credit limit to set, and banks also use this information to determine which customers are likely to bring in the most revenue. So when depending for banks for sources of financing, you should consider that from their point of view, you're just another customer. So if not banking, the other way to fund a corporation is by issuing corporate bonds or company stock. So what are the difference here? The difference are that when we issue corporate bonds, we actually issue debt, whereas when we issue company stock, we actually make more people co-owners of our company. Let's start with the corporate bonds. As I already said, this is a debt approach to financing. Each corporate bond holder has two distinguished rights by owning the corporate bond. First is the right to have a return, typically some sort of interest rate, which is typically fixed, or the rule of determining the size of the interest rate is fixed. So in the latter case, this is called a floating interest rate. Second right a holder of a corporate bond has is a priority in case of liquidation of the business. There are several requisites for each corporate bond. First of all, there is a nominal. This is the nominal size of the capital which this corporate bond raises. Second of all, it is the interest, or in some case it's called discount, divided in time frames, which are typically denominated in the so-called coupons. And the third requisite is the name of the holder, or in some cases it is written bearer, which means the corporate bond is not put to somebody's given name, but to the bearer of the bond. Company stock is issuing company stocks is actually equity approach to financing, which basically means you make more co-owners in your company, and the shareholder of a company stock has 5 distinguished rights. 3 of them are economical rights and 2 of them are management rights. The economical rights are ownership of a share of your business, first of all. Second of all, the shareholder has the right to dividend. The dividend might exist or might not exist, and it's not a predetermined amount, which is a big and huge difference to the corporate bond. Third, the shareholder has the right to liquidation share in case of bankruptcy of the company. Fourth, the shareholder has the right of information about the business. So basically, every shareholder could have some sort of control over the business operations of the company. And fifth, every shareholder holding a common stock in your company has a proportional vote in the General Assembly of the shareholders. So he or she actually is part of your decision making. The requisite of each share are actually two. One of them is nominal, and this is only a requisite in Europe. In some other places of the world, it is not a requisite. And the other is again the name of the shareholder or the label to the bearer. So in recap, there are internal and external sources of financing, and at the same time there are short-term, medium-term and long-term. And for each of them, for each of these 6 quadrants, there are different typical sources of financing, which are out of which the most important probably is issuing new shares and corporate bonds, retaining some profit, and short-term loans or overdraft. So what we have done in this lecture is that we reviewed the company financial operations and the role of corporate finance. Next, we reviewed the form of organization of the business and the analysis of financial statements. Next, we reviewed the way a company is funding its operation in various ways, depending on term and depending on the source of funding, external or internal.